Hello and welcome. In this lecture video, I'll talk about the four accounting assumptions, forms of business entities, and then we'll also do a few quick check problems as well, okay? All right, so in the last lecture video, I talked about the four principles of accounting, such as the revenue recognition principle and the cost principle, the matching principle and the full disclosure principle. Let's talk about some assumptions that we make in accounting. So the first one is the going concern assumption. And basically we're assuming that the business is going to continue to operate rather than being closed or sold. Okay, so this assumes, for example, that we would report a property at cost rather than at its liquidation value. So the fact that we do that not only reflects the cost principle, but also the going concern assumption. The other one is that we have a monetary unit assumption, that we have to express transactions and different activities in an organization in terms of dollars or euros, any monetary unit, okay? So we have to be able to express events and activities in terms of monetary units, such as dollars. The other one is that we have a time period assumption, and basically this means that we can separate the life of an organization into discrete time periods such as years or months. Okay? And so when we talk about the accounting period, we typically mean 1 year. Okay? That could be the calendar year, but not all organizations have their fiscal year, their accounting period, on the calendar year. For example, the U.S. federal government ends its its fiscal year on September 30th, which is obviously different than the December 31st calendar year end. Okay, but when we talk about the accounting period, that's another term I've used before, we typically mean 1 year. All right. The other one is a business entity assumption, and what we're saying here is that we are going to account for a business separately from its owners. So if, for example, the owner of a company they own just a small plumbing company, for example, and they want to purchase a family car. That family car is not used for the business. It's used maybe for the spouse to get kids to soccer practice, for example. It's used for non-business purposes. Okay, so what the business would not do, the plumber could not do, is to include that family car as an asset of the business, because it's not for the business, it's the family car. So what the owner would have to do, in this case, if he or she wanted to purchase the family car, is that he or she would have to withdraw money from his or her business, take money out of the business as a withdrawal, move it into his or her own personal checking account, and then use the money in his or her own personal checking account to purchase the family car. So the purchase of the family car is for the family, it's not for the business. So it can't be included in the business's activities. Okay? That's what we're saying right over here, is that we're going to account for those activities with the owner, or personal to the owner, separate from those of his or her own business. That's the business entity assumption. Okay? There are a couple different forms of business entities. We have a sole proprietorship, and that's just a business that's owned by one person. There's no special legal requirements to start a proprietorship. It's also not a separate legal entity from its owner. That can be tricky, because that means that your personal assets could be used to pay for proprietorship liabilities. So for example, if you have some outstanding liabilities from your sole proprietorship, you could take your own family car, which is your personal asset, to pay off those liabilities. Okay? Also, the other thing about a proprietorship is it's considered a pass-through entity. So that means that proprietary income is not subject to business income tax. It's reported on the owner's personal income tax return. We also have a partnership, which would be a business owned by 2 or more people, partners. Requires a partnership agreement, and in that partnership agreement, the owners would specify, maybe we'll split profits and losses 50-50 or 60-40. So they're going to specify how they split the profits and losses from the business in that partnership agreement. They'll also say who gets how much assets upon liquidation. So those kinds of things would be specified in the partnership agreement. We talk more about this in Chapter 12. There is unlimited liability for a general partnership, or as we'll talk about in Chapter 12, there are different types of partnerships and not all of them have unlimited liability. Okay, but for a general partnership, there's unlimited liability, which is similar to the idea of the proprietorship, where you could use personal assets to pay off business liabilities. Okay. The partner shares of the profits are reported on the partner's tax return. That is similar to the proprietorship idea. Okay. It's reported on your own personal tax return. A corporation, on the other hand, is a business entity that is separate, so legally separate from its owners. It acts through the managers who are its legal agents. So who are the managers? We could say the CEO, Chief Executive Officer, the Chief Financial Officer, the Chief Information Officer. Those are the ones that run the business. And the owners of the corporation are the stockholders or the shareholders. So when you buy stock in Apple, for example, you become an owner of Apple. Okay. The owners are not personally responsible for corporate acts or debts. So this means that if Apple were to go out of business, right, the most that you're going to lose is the value of your share of stock. If you bought 1 share, they're not going to come take your personal car to pay off the debts of Apple. That's different than a general partnership and a sole proprietorship, or they could do that. That's because this is a separate legal entity. Okay, so Apple incurs debts. That's Apple's problems. Even though I'm an owner of Apple, you won't come take my car to pay off Apple's debts. Okay, the most I'll lose is the value of my share of stock. There's also this idea of double taxation with a corporation. You may have heard this before. What this is saying is that corporation income is taxed. There's corporate tax rates. But then dividends. Dividends are a distribution of assets, typically cash, to shareholders. So what happens is, on a quarterly basis, the corporation, let's say Apple again, they say, well, we had a great year, and because we had such a good year, we're going to send everybody a 50-cent check, or 50 cents for every share of stock that you own. So if you own 2 shares of stock in Apple, you'll get a check from Apple for $1. That's called a dividend. Okay, so distribution of assets back to its shareholders. That's a dividend. Here's the thing. If I'm an owner of Apple, right, there's the corporation that I'm part owner of has to pay taxes on its corporate profits. Okay, but I also get a dividend from Apple. I have to report that dividend on my personal tax return. So then that is taxed as well. So there's double taxation. That's what this is talking about. Okay, and so then we have this figure that goes through and lists characteristics such as business entity, legal entity, limited liability, unlimited life, business tax, one owner allowed, and it says it for proprietorship, partnership, and corporation. Let me quickly just go through this. When we talk about a business entity, that would be yes for proprietorship, yes for partnership, yes for corporation. Legal entity, no proprietorship, no partnership, yes for corporation. Limited liability, no for proprietorship, no for partnership, yes for corporation. Okay, and we'll talk more about this limited liability, especially for partnerships and sole proprietorships, in a little bit more detail in Chapter 12. Okay, unlimited life, no for proprietorship, no for partnership, yes for corporation. So let me talk about this really quickly in terms of corporations. So I am a shareholder of PepsiCo. I own a few shares of stock in Pepsi. PepsiCo is the name of the company. Okay. If I die, does Pepsi continue operating? Yes. If I'm part of partnership and I die, does the partnership continue? Not in that current form. We would have to rewrite the partnership agreement. Okay, so no. Yes for a corporation. Business taxed, talked about that. No for proprietorship. No for partnership. Yes for corporation. Right up here, corporation income is taxed. One owner allowed. Yes for proprietorship. No for partnership because it's two or more people. And then yes for a corporation. Okay. Let's go over here to our quick check problems. And what I want you to do is do these two quick check problems that are, these quick check problems on these next two pages, on pages 8 and 9, and then we'll check it together. Okay, so pause the lecture video, do these quick check problems on pages 8 and 9, and then we will check it together. Okay, thanks. Okay, hello and welcome back. Let's take a look at these. So the private group that currently has the authority to establish GAAP, Generally Accepted Accounting Principles, is the FASB, which is short for the Financial Accounting Standards Board. B is the right answer. The next one, number 97, to include the personal assets and transactions of a business owners in the records and reports of the business would be in conflict with C, the business entity assumption, which says we need to keep those separate. The next one, number 96, of a parcel of land that was originally acquired for $85,000 is offered for sale at $150,000, is assessed for tax purposes at $95,000, but is easily recognized by its purchasers as being worth $140,000, but then is sold for $137,000. The land should be recorded at which option? And the right answer is B, $137,000, which is the cost. Remember the cost principle. This is consistent with the idea of the cost principle. So it's reported at cost, which is the $137,000, which is the idea of the cost principle. Okay, let's take a look at the next one on page 9, number 103. It says on December 15th of the current year, Myers Legal Services signed a $50,000 contract with the client to provide legal services to the client in the next year. Which following accounting principle would require Myers Legal Services to record the legal fees revenue in the following year and not in the year in which the cash was received? So this one's a little tricky. Okay, and so basically what this is a situation where a company gets paid up front. Okay, so they got paid up front, they got paid in year 1, but when they're going to provide the services is in year 2. So when do they record the sale? When do they record the revenue? They record the revenue in the period in which they do the work, because that's when they earned the revenue. So remember the revenue recognition principle, such as you record revenue in the period in which it's earned, which is in this case the period, the second year, which is when they provide the legal services. So they can't record the revenue until the next year when they provide the legal services because of the revenue recognition principle, even though they got paid in year 1. They get paid year 1, they do the services in year 2. When do they record the revenue? In year 2, when they perform the services, because that's when they've earned it. Technically, actually, what they have in this situation is that Myers Legal actually has a liability to provide those services in the future. So they actually have a liability. This situation is called unearned revenue. That's what this is called, unearned revenue. Okay? With number 108, which of the following accounting principles prescribes that a company record its expenses incurred in the same accounting period to generate the revenue in that accounting period? The right answer is B, matching principle. And let me return back up here to number 103 because I realized I didn't tell you the right answer. The right answer is E, the revenue recognition principle. Okay? All right, so that's the end of this lecture video. In the next lecture video, I'm going to talk about the accounting equation and also define assets, liabilities, equity, revenues, and expenses. Okay? Thanks so much.